We're back on a Monday night, everybody. John Navin is here from John Navin and Associates. We're talking about financial risks, investments, and fees. And good to have you with us.
Thank you.
Thank you for being here. If you'd like to call in, 615-737+. That's the phone number. We're taking your calls. All right, I want to talk a little bit more about some of these hidden fees. And this one article here that you sent me, actually from Forbes, there's one group of, they call cost-conscious investors, that have broken down transaction cost into three categories. They've got brokerage commissions, market impact, and spread cost. Brokerage commissions kind of defines itself, right? Yes. Mutual fund managers buying and selling stocks for investors and all that, but these, you know, this second one, they even say it's even more difficult to estimate its market impact cost. A mutual fund making a large transaction in stock that will move stock price before the order is completely filled. I mean, there's just a lot of stuff, and some of this stuff is not even in those prospectus.
No, you don't see it. It's tough to see. That the cash drag, or what they're referring to there, or the market moving, is you have all these mutual fund managers, and they're supposed to go to the market, and they determine that they want to buy Apple. They want to buy a stock. Well, if you're going to move $1 million or $2 million of mutual fund people's assets, it's going to take a while to fill all those orders. You can't just go buy $2 million worth of Apple stock. So what happens is, of course, as people start buying the stock, what happens to it?
Goes up.
If they start selling it, it goes down. So if you're trying to move that large of a position, you're not going to get your whole order filled. Well, you as the personal investor of the mutual fund, they only came out with one blanketed price, where you could have got in at $101, it might have been $102 by the time the whole order got filled. So that's a cost to you, a lost opportunity cost, and a real cost, because you just can't get it. So those costs add up to about 1.5% is what they say, between transactions and turnover, and then there's also taxes inside there. If you're in a non-IRA account, if you're inside your IRA account, you don't have to realize that. But and then you have the brokerage commission, which is they're going to charge you 5.5% up front, or they're going to charge you an annual fee, or they're going to charge you a deferred sales charge. It just depends on how you purchase it.
So when you do this stress test, is it a stress test just for the particular funds and the finances, or is it also a stress test for your clients? Is this an opportunity for you to see what their risk assessment level is? I mean, what if you have a client who comes in and says, John, I'm aggressive, and I want the most aggressive portfolio that you can give me, and I don't care about the risk. I'm going for it. I believe in the market.
Yes. The portfolio stress test is the whole portfolio, right? Because you will point that out exactly. And if they don't have money in the proper buckets, you shouldn't be. Now, I got to be careful, because I can't make recommendations without sitting down with somebody. But my suggestion, if I can be politically correct, would be that you allocate the money you need for the cash and the guaranteed income before you go be aggressive. But you're right, in that last bucket, if you took care of those first two, you can do that. The problem is the feeling of euphoria does not last near as long as the feeling of loss and pain. So we may feel great because we made this big win, if you will. That may last for a little bit, but next year, if the market falls like it did in 2008, and you're down 38%, that still stings.
How do you think that market crash in 08 and the financial crisis affected the last 5 or plus years of investment? You think that there was a good learning lesson for a lot of people, that it was a wake-up call, and we've kind of reassessed? And because obviously down the line it's going to happen again. There are ups and downs, and the stock market dips. It dips. And how much? That's the thing. How quickly and how much, and how ready are we going to be for it?
Yes.
Because a lot of people were not ready in 2008.
No, and there was a lot of folks that thought, okay, I can just hang on one more year and then I'll retire, because if it goes up another 15%, then I'm really set. Well, then the market crashes and it hits you. So what happened, we have a lot of people still sitting on the sideline who became leery or afraid of the stock market because they didn't want to enter back in. Where we have been on a bull market ever since that time. So we're on a 7-year bull market right now. So at some point, the market probably will shift or turn or go the other direction. When? No one knows. You'll hear a lot of people, and you'll hear both sides. But again, my belief is to have money allocated into the right buckets, and you don't have to worry when it happens. Then you can absorb the risk in that long-term bucket because you're not affecting or jeopardizing the rest of your portfolio.
Right. All right, 737 plus. If you'd like to call in and get some advice or make a comment about your investments and perhaps how 2008 affected you. I know it was not a pretty sight. At some points when I would get that statement, I didn't even want to open it. No. I just made a conscious effort. I'm not even going to look at it because I know that it's dropped in value, and I'm just, we're going to have to ride this out in the long run.
And I'm assuming you're doing something called dollar cost averaging, or people, not just you, people who are investing in their 401k or their IRA or work plans, 403bs, whatever the case might be. You're consistently putting money in each month.
Right.
And so they call that dollar cost averaging. So over the course of a year, you are averaging or putting money in over that time period. Typically what happens at the end of the year, you have paid less per share than the average price per share stock or the average price per share of the mutual fund that you bought into. So it's a good thing just to keep going and putting the money in. Again, if you have that 10-year or longer time horizon.
Why is it so important? One of the first lessons or piece of advice that I got when I started working regularly and I had an opportunity to join a 401k at my work, which so many other people I know have that opportunity, and fortunately the company throws in a share as well, a matching. And the first thing I was told was do the maximum. Do the maximum from the get-go. Don't do anything lower. Do the maximum ratio or maximum amount per year that you're allowed to put into it, and just let it, do its thing.
Yeah.
Why is that so important? Because of the snowball effect.
There's a couple things. One of them is called the time value of money.
Right.
So what happens is the longer that money is there, it multiplies, snowball effect. I was debating about telling a story. We'll go really quick.
No, go ahead. We got time.
We got time. We'll tell the story. So what happened? The time value of money is people think that if they buy something, that's what the cost is. Well, the real cost is not what you paid for the item. For example, let's say you had a $2,000 TV you wanted to buy. Well, a lot of Americans will buy that on credit, which is now it's costing you 18% more than, or whatever the rates are now, 13, 14% more. But you also lost that opportunity to make money on that $2,000. So here's the example. There's a rule called the rule of 72. And what that means is if you take the interest rate into 72, that's how often your money will double. So for math purposes, let's say we could get 9%. 72 divided by 9 is 8, right? Maybe the right math? Okay,
yeah.
Good. That means your money will double. If you're getting 9%, it'll double every 8 years. If you were 25 years old, saving that money for retirement, 40 years, right? Stick with me, this may be tough for me. I'm being dead serious. All right, so 40 years, if it's going to double every 8 years, it's going to go 5 times, right?
You're talking about $2,000, right?
$2,000. Right. So if it's going to go 40 years, it's going to double 5 times. So 2 is going to go from 2 to 4, 4 to 8, 8 to 16, 16 to 32, 32 to 64,000. So your $2,000 TV did not cost $2,000. It cost you $64,000 because you lost the opportunity to make money on it. So that's the key, is to start early.
But you gained hours of entertainment in front of a high def.
And you could watch the best news channel ever.
Yes, $64,000.
Yeah.
Wow.
Yeah.
That's a good point. And as I have learned, if you put aside some money and you pay cash for that TV, I bet you can get it for $1,700 or $1,800 because you have negotiating power, don't you?
And TVs now, the good news with TV lovers is TVs are cheap. They're actually down. I just read this in the journal the other day. They're down 58% in the last 5 years. So TVs are getting inexpensive.
737 plus, if you would like to call in. It's a nice evening out. So if you're just coming in from that barbecue out in the back deck, give us a call. 615-737 plus. We hope you'll take advantage of this hour. So we've got all these hidden fees and hidden costs. Is there any way to avoid them altogether?
Yes. Altogether, maybe a stretch. But you can definitely minimize them. One big thing that we see is the difference between institutional investing and retail investing. For example, Fidelity has a retail side. Fidelity also has an institutional side. So we will trade through Fidelity as a platform that we use. And you can use all, people have seen Fidelity, TD Ameritrade, Pershing, Schwab. There's all these different platforms that you can trade on. One of the things that I see is that people who have probably 250,000 or more have outgrown the retail world. So meaning they're still going to the Fidelity store and buying retail. Well, anytime you buy retail, you're going to pay more than if you go direct and buy
$250,000. You mean in
investable assets?
Investable assets.
If you're,
okay.
And you could probably even do it at 150,000 or more.
Right.
You don't need to go to the Fidelity store. Not that the Fidelity store is not bad. You just can, as you accumulate more assets, you've grown and outgrown shopping at the retail store.
Right.
Similar to Sam's versus Walmart. As you go to some of these higher end places, maybe not higher end places, but you can buy more wholesale and buy direct versus buying retail.
Right.
So that would be the biggest thing I see. So you can cut out a lot of the retail fees and just go direct.
Makes sense.
You just got to find a broker. You got to find someone that'll help you facilitate the transfers and the trades and that kind of stuff. But which gets confusing too.
A lot of.
But you can cut the fees out. That'll cut
a lot of the fees. I mean,
And there's a lot of ways to do it with institutional money. So you can have institutional money managers. There's ways to use REITs and ETFs and no loaded funds. So we do a lot with funds that typically, and money managers that do not overly active manage the portfolio. And that's a whole different conversation too. But anytime you're buying and selling and trading all the time, the fees and the expenses go up. But if you can have access to some no-load information or some funds that go direct, your fees get cut.
Sure.
Our average portfolio, for example, is probably, with our fee in there even, it's less than one. It's right at 1%,
right.
1.25%, which is less than if you bought the Fidelity fund direct from the retail store at 3.5%. So
sure. Take another break, everybody. We'll be back with more John Navin right after this.